In this video, I will show you two examples of how to do a transaction analysis with an equation analysis sheet. So on the left right now, this is the equation analysis sheet, and on the right is a question. So you should already know what assets, liabilities, and owner's equity, what they are. Let me just explain the equation analysis sheet a little bit. So in column B, these are the dates of the transactions. For example, number 1, this just means the transaction that will happen on May 1, since the question is talking about May. And then over here on 2, it's going to be talking about the transaction that occurred on May 2nd. Okay, so let's start with this question. Verma's repair shop was started on May 1st by A. Verma. A summary of the May transactions follows. Okay, let's start with May 1st. Invested $14,000 to start the repair shop. So usually in these types of questions, the first transaction is going to just be putting money into the company, which is basically if you invest money into the company, it's the same thing as putting money into the company. So this affects cash and owner's equity, the capital. Because if you're putting money into the company, the cash is going up because you put the cash into the company. And also, you, if you're the owner, your capital in this company is going up because of the money that you put into it. So here we can just make cash go up by 14,000 and the capital will also go up by 14,000. So in these sheets, the left side and the right side have to balance. So if you have 14,000 in cash, you have to have 14,000 in one of these accounts, or you can have negative 14,000 in these accounts, because at the end of the day, the assets here has to equal all of these. So that's why we want them to balance. Okay, let's go to the next one. May 2nd. Purchased equipment for $8,000, paying $2,000 cash, and signing a note payable for the balance. Okay, so in this example, 3 accounts are going to be affected. First, in the question, it says purchase equipment for $8,000. So equipment is an asset. So you're just getting an asset into your company, and we record on the equation analysis sheet what it's worth, not what you paid for it. So here it says purchase equipment for $8,000, but it says paying $2,000. But what it means is it's worth $8,000. So we're going to put what it's worth right now. Okay, and then you paid $2,000 cash. So the cash account is going to be affected. And now you're paying money. So are you adding money into your company, or are you taking money out of your company? Well, you're taking it out because you're paying it. So it would be negative 2,000. Okay, so the next part is you signed a note payable for the balance. So that just means you're going to pay the money that you owe at a later date. And since it says note payable, obviously the notes payable account is going to be affected. So If you think about this logically, the equipment is $8,000, but you only paid $2,000. So how much do you owe? That would be 8,000 minus 2,000. So you owe $6,000. And another way you can think about this is you know that the two sides have to equal. So if you just look at the assets, 8,000 minus 2,000 is 6,000. So assets is 6,000. So here, one of these accounts have to be 6,000. Okay. Now, the next transaction on May 5th is paid rent for the month, $640. So if you're paying something, the cash is going to go down because you're taking money out, and it's going down by 640. So I'm going to put negative 640 for cash. And now, one of these accounts also has to go down by negative 640. And since it says paid rent for the month, it's going to be the expenses that is affected. And this part is a bit confusing because it's also negative 640, but this is just showing the reason why it's negative is because it's making the owner's equity negative. Because if you're paying money, your money that you have as an owner, it's being less, right? Because you're paying money. So that's why there's a negative here. And the reason why it's expenses is because rent, also different things that you're just paying, like rent. You can also pay things for utilities, or if you have like a telephone bill or advertising bill that you have to pay, everything that you have to pay that you're not getting any assets from, it goes into expenses. So that's why, for example, in the second transaction, when you're purchasing equipment, expenses is not affected because equipment is an asset, but rent is not an asset. It's just something that you have to pay. Okay, now for the seventh transaction, purchase $350 of supplies on account. So if you just read the first part, you purchase $350 of supplies. So the supplies are worth $350. This is going to increase the supplies account. And later it says on account. So in the question, purchase $350 of supplies on account. So on account means you're just going to pay it later and you're not going to pay it right now. That's why cash is not going to be affected in this question because you're not paying anything right now. You're going to pay it later. And whenever you're going to pay something later, when you're buying an asset, it's going to go into the accounts payable account. So you're going to pay $350 later. So as you can see, this column 6, it's balanced because there's $350 in the assets section and $350 in the $350 in the liabilities plus owner's equity section. Okay, now for the the transaction on May 9th, received $2,100 in cash from customers for repair services. Okay, so if you're receiving money in cash, well, the cash is going to go up because you received that money and it's in cash. And it says for repair services. So this kind of money that you receive is called revenue because it's directly the money you're getting. The reason why you're getting this money is because you offer them your service, and the service is part of the company. So when you get money from doing something that your company is supposed to do, that increases the revenue. So revenue will be increased by 2,100. And as you can see, column 7 is balanced. Okay, so for the next transaction on May 15th, withdrew $500 for personal use. So whenever in a question you see something similar to you're taking out money out of the company and you're going to use it for your personal stuff, the drawings account is going to be affected. So drawings is an account used for these types of situations where you're taking money out of the company for personal use. So if you're withdrawing $500, cash is going to go down by 500. And then, as I said before, drawings is also going to be affected by negative 500. And it's negative because these accounts, whether they're positive or negative, it depends on if they're increasing or decreasing owner's equity. So owner's equity is decreasing because you're taking money out and you're using it for personal use. So whenever this happens, drawings decreases by 5. Drawings will decrease if you're using something for personal use. And as you can see, it's balanced. There's negative 500 on the asset side and negative 500 on the liabilities and owner's equity side. On May 16th, provided repair services on account to customers, $1,800. Okay, so it says on account, but in this case, the customers are affected by this because the customers aren't paying you right away. They're going to pay you later. So whenever this happens, when the customer has to pay you later, it goes into the accounts receivable account. So they should pay you 1,800, but they're not paying you now. If they're paying you now, it would go into cash. But they're not going to pay you now. They're going to pay you later. So it goes into accounts receivable. And remember what happens when you get money because of a service that your company is supposed to provide? This makes the revenue go up. So revenue must also increase by 1,800. Okay, now in May 26, collected $500 on account for services billed on May 16th. Okay, so if it says you collected $500 on account, that's just saying that your customer has now paid you $500 cash from what they owed you on May 16th in this case. So remember in May 16th, they owed you $1,800. Well, now they're paying $500 of that. So cash will go up by 500 because they're paying you for that. And now they're going to owe you $500 less. So in the accounts receivable column, it's going to be negative 500 because now they don't owe you 1,800. They owe you 1,800 minus the 500 that they have now paid you. And this is an example where in the assets section, it's going to balance because 500 minus 500 is 0. And then in the liabilities and owner's equity section, nothing is happening to it, so it will also be 0. So this is also going to balance. Now, on May 27th, paid for supplies purchased on May 7th. Okay, let's take a look at May 7th. Purchased $350 of supplies on account. Yeah, so in this case, you owed money because you didn't pay it right away. But now it says you paid for the thingy. You paid for the supplies. So let's take a look at this. It looks like now you paid $350 because that's what the supplies were worth. So if you paid $350, cash is going to go down because you're taking money out by paying. And then the accounts payable is what you owe. So do you owe this anymore? Even though you've already paid it? No, obviously, because you paid it. So you don't owe this anymore. The amount you owe is going to be $350 and then minus $350. You owe zero now because you paid it all off. So that's why you have negative $350 here because you paid it, and in this column it's telling you what you owe. Okay, and now for May 28th, you paid $220 for advertising. So whenever it says paid, you're going to decrease the cash because you're taking money out by paying things. So you paid $220. So cash is going down by $220. And this is for advertising. So is advertising an asset? Well, it's not over here, so it's not an asset. That means it's going to be an expense because you're paying money, but you're not really getting stuff for your company. You're not really getting an asset. So expenses are going down by $220 because paying money is going to decrease the owner's equity if it's not an asset. Now, for May 31st, so there's 3 transactions. Let's just start with the first one. Received May telephone bill, $100. So here, you're not paying anything, but you got a bill. And a bill means you have to pay it later. And whenever you have to pay something later, it's money that you owe, it goes into accounts payable. So it says, received May telephone bill, $100. There. So now you owe $100. And a telephone bill, this is not an asset, so it's going to go into expenses. And expenses, I'm pretty sure it's always going to be negative because expenses always decrease owner's equity. So negative $100. And as you can see, it's going to balance because nothing happened in the assets. So these are all going to be 0. And then if you add this, 100 plus negative 100 is 0. So this is going to balance. Next transaction. Paid part-time employee salaries, $1,000. Okay, so now you see paid again. That means cash is going to go down. This time by $1,000. And again, for employee salaries, this is not really an asset. So it's going to go into expenses, and expenses are going to decrease by $1,000. Okay, now for the last transaction, billed a customer $350 for repair services. Okay, so this customer is not going to pay you right away since you billed them. And this means that the customer owes you $350 because you already did the repair services, but they have not paid you yet. And whenever a customer owes you money, it goes into accounts receivable. So they owe you $350. And remember, the account that is affected whenever you are doing a service that your company is supposed to provide, revenue will go up by 350. Okay, so now what we do is we're going to add everything in each column. So let's see if I still remember how to add. Okay, so let's start with column C, cash. C, 31. Okay, so this is not working, so I will get my calculator. Okay, so what we're gonna do is add up all the numbers in column C, cash. So 14,000 minus 2,000 minus 643 plus 2,100 minus 500 plus 500 minus 350 minus 220 and minus 1,000. Okay, so what I got is 11,890. And now we're going to do the same thing for accounts receivable. 1,800 minus 500 plus 350. I messed up on my calculator, so I have to do it again. I got 1,650. Okay, oh my gosh, thank goodness supplies is just 1. So 350. Equipment is 8,000. Now we're going to do the same thing on this side. 350 minus 350 plus 100 is 100. 6,000 is just 6,000. The capital is just 14,000. Drawings is negative 500. Revenue is 2,100 plus 1,800 plus 350. That's 4,250. Now expenses, negative 640 minus 220 minus 100 minus 1,000. That's negative 1,960. Okay, so now what you want to do is make sure that the two sides of the highlighted equal sign are equal to each other. Okay, so I'm going to try to add this again, and I really hope that this works. Okay. C, 16. F, 16. Okay, yes, it works. Okay, so that means what I did right here was I added all of these numbers, and these are all the assets. Now let's do the same thing for liabilities. 6,000 plus 100 is 6,100. And owner's equity. Owner's equity is these accounts. So I'll just do it on my calculator. 14,000 minus 500 plus 4,250 minus 1,960. Okay, so I got 15,790. Okay, now what we want to do is see if assets equals liabilities plus owner's equity. So to do that, I'm just going to add liabilities and owner's equity. So 6,100 plus 15,790. Yeah, so that equals 21,890. So notice that this number is the same as assets, and that's what's supposed to happen if everything goes well. Assets are supposed to equal liabilities plus owner's equity. Okay, now let's work on our second example. Let's read the question first. On April 1st, Angela Loken established the Loken Travel Agency. The following transactions are for her first month of operations. April 1, deposited $12,000 in the agency's account at the Canadian Imperial Bank of Commerce. Okay, so what does this mean? This is really similar to last example where the first transaction is you're just adding money into the company. So when this happens, cash goes up because that's the money that you're adding, and capital goes up as well because your capital is going to increase when your business has more money. Okay, so April 2nd, paid rent for the month $600. Okay, so you're paying money, that means cash is going to go down, and it's for rent, and rent is not an asset. So expenses are going to be affected, and it's going to go down by 600. Okay, next. Also April 2nd, purchased office equipment for $5,500, paying $2,000 cash, and signing a note payable for the balance. So what is happening right now? You bought office supplies, but you only paid $2,000, and you're going to pay the rest of it later. So if we just focus on the first part, it says purchased office equipment for $5,500. So eventually you're going to have to pay $5,500 for the office equipment. So office equipment is an asset and it's going to go up by $5,500. And you paid $2,000 cash. So cash is going to go down by $2,000. And you owe the rest, which means it's going to go into accounts payable. But in this case, it's specifically telling you a note payable, so it's going to go into notes payable. Let's see how much you owe. If the office equipment is $5,500 and you paid only $2,000, how much do you owe? Well, you can just do 5,500 minus 2,000, and you owe 3,500. Okay, on April 7th, incurred $300 of advertising costs on account. So on account just means for you that you're going to pay this later. Okay, so right now accounts payable would be affected since it does not say notes payable. So that means you can just assume accounts payable is going to be affected. Okay, and it's advertising costs, so you're not getting any assets. This is going to be an expense, and expenses, I'm pretty sure, always go down because how can paying money for something that's not an asset increase your value as a company? Like, it won't increase your value, so it's going to go down. On April 8th, paid $725 for office supplies. So here it says paying money, so cash is going to go down by $725, but you get office supplies. So office supplies is an asset, and this is something that is going up because you're getting office supplies, you're not removing office supplies. So you can put $725 of office supplies that you now have. Okay, on April 11th, earned $9,000 for services provided, with $1,000 paid in cash and the remainder on account. Okay, so this is a bit similar to the other one we did, April 2nd. Okay, so earn $9,000 for services provided. This means that the service you provided was worth $9,000, and that's the amount you should get. And whenever you do a service that your company is supposed to provide and you get money for it, it goes into revenue because it's going to increase your owner's equity. And $1,000 paid in cash, that means the customer is paying you $1,000. So the cash is increased by $1,000, but they didn't pay all of it. So how much did they not pay? If you're supposed to get 9,000 and they only paid you 1,000, well, 9,000 minus 1,000 is 8,000. So that's the money that they still owe you. And whenever they owe you money, whenever someone else owes you money, it's going to go into accounts receivable, which is the money that they're going to pay back to you. So it will just increase by 8,000 because that's the amount that they still have to pay back to you. Now, on April 15th, withdrew $500 for personal use. Okay, so remember whenever you withdraw something and it's for personal use, the cash and drawings are going to be affected. So cash, how much did he take out of the company? He took out $500, so it's going to be negative 500. And then drawings is going to be affected because this is reducing owner's equity in the company because they're taking out money for the owner's personal use, which is separate from the company. So it's going down by 500. On April 25th, paid the amount due in the April 7th transaction. Okay, so let's go back to the April 7th one. Incurred $300 of advertising costs on account. And yeah, here it is. And now it's saying that you paid it. So whenever you're paying something, the cash is going to go down. So in this case, it's 300. And what other account is going to be affected? Well, you're not owing $300 anymore because you just paid it. So it's going to go down. Accounts payable is going to go down by 300. Okay, so the final three transactions. Paid employee salaries $3,200. Okay, so you paid money. Cash is going to go down by 3,200. And is employee salaries an asset? It's not. So whenever you're paying something but it's not an asset, expenses is going to go down by 3,200. Okay, and the second transaction that happened on April 30, received a bill for utilities for the month, $1,000. So you're not paying anything, you just got a bill. A bill means you owe someone money. And whenever you owe someone money, accounts payable is going to go up. So how much do you owe? You owe $1,000. And utilities, that's not an asset, so it's going to decrease the expense by 1,000. Now for the last transaction, Received $6,000 from customers who were billed in the April 11th transaction. Okay, so in the April 11th, it just says earned $9,000 for services provided with $1,000 paid in cash and the remainder on account. Here it is. And now it's saying that you received $6,000. Okay, so when you're receiving money, the cash goes up because you're getting money. And now what other account is going to be affected? Well, they don't owe you $8,000 anymore, do they? Because they just paid you $6,000. So how much money do they now owe you? Well, they owe you $8,000 minus the $6,000 that they paid you. Okay, now we're done, so we can add up all of these. Okay, so I'm gonna try again to add it up using Google Sheets. C3, C13. Okay, yay, I think it worked. Accounts receivable, 8,000 minus 6,000 is 2,000. Supplies, just 725. Office equipment is just 5,500. Accounts payable, 300 minus 300 is 0, plus 1,000. Notes payable is 3,500. Capital is 12,000. Drawings, negative 500. Revenue, 9,000. Okay, so expenses, negative 600, minus 300, minus 3,200, minus 1,000. That is 5,100. Okay, so now let's add up the assets, which is all the accounts on the left side of the equal sign. And now let's add the liabilities, which is only accounts payable and notes payable in this case. So 4,500. And owner's equity. Let me just use Google Sheets again. Okay. Hold on. Okay, I know what happened. Expenses is supposed to be negative. Okay, let me just add this to my calculator. Wait. Yay. Okay, so the computer just did it for me. Now let's add liabilities and owner's equity and see if it equals assets. Okay, so it does. There, now you can see how assets, which is 19,900, equals liabilities plus owner's equity, and this is just the accounting equation. So I guess now you know how to do this kind of equation analysis sheet. Thank you for watching, and I hope you have a great day.